more importantly and more interesting, is Mr. Chris. So Chris, huge welcome today. I just want to hand over to you, explain a little bit about who you are, your background, and a bit about Playfair. And then I think we've already got a question set that we went through before, so I'll just run through that.
All right, perfect. Well, first of all, thanks so much, Mark, for asking me to join. And I love what you're building. I think community is so important for founders, because ultimately it's only really other founders that know what you're going through, and they know the highs and the lows and all the in-betweens. So I really love what you're doing. So I'll start with Playfair, because that's more interesting than me. So I'll start with Playfair. So we're a pre-seed fund based in London. We've been around for about 12 years now, investing out of our third fund, which is a $70 million fund. To cover the basics, pre-seed, we do checks between normally around 750 and $1 million. We can go much lower into an angel round, so maybe even as low as 100,000 and up to 1.5 million if there's something exceptional. And we're generalists, so we look at pretty much everything. There is a short list of exclusions if you want to go to our website, and our frequently asked questions includes things like gaming, gambling, weapons, but it's a pretty short list. We like most businesses. I'd say we have a little bit of a preference for B2B, and we quite like deeper technology, more complicated problems, things that are quite difficult to build. So that's us. We are a little bit different though. So we only do 6 investments a year. Most pre-seed funds will do 20, 30, 40 investments a year, try and index the market. We are very selective, and we go really deep with those companies. So we get to know you extremely well. We write, really extensive investment memos, almost sort of like Series A level of rigor. And we do that to try and make good decisions, but also so our conviction is real. It's actually backed up by the work we've done. And that means we can support you in follow-on rounds, whether it's a C+ round, whether it's Series A, and we reserve 60% of the fund to do that. The result is that 78% of our companies have gone on to raise Series A against an industry average of about 20%. So something is working. And then very briefly on me, so I've been at Playfair for 7 years. Prior to that, I took a long time to get into venture. My team are a lot smarter and more decisive than I am. So I founded my own telecoms business at university, scaled it to about 14 countries. It turned over like £250,000 in the best year. It was so much fun building it, but I learned everything you shouldn't do to build a scalable business that's suitable for venture. I then spent 10 years in the city as a corporate lawyer. Very miserable years, actually hated it. The financial crisis in 2008 stopped me escaping. And I guess my creative outlet at the time was angel investing. So I made 15 angel investments over the years, 6 exits from those. So a couple have gone public, 4 have been acquired, a couple have failed, a couple are still looking pretty good. And then the last step before Playfair was moving to the Isle of Man. And I worked for a B2B telecoms company called Plan.com, 2 years as sales director, to build and scale the sales team of 15 people, and then moved across around the software development and data science team. We got to 60 million of revenue and about 100 people by the time that I left. And I've been at Playfair ever since, and I love what I do. And I always say to the team, you're going to carry me out of here in a box.
Absolutely love it. Fantastic. What a great introduction. And so, yeah, today we're going to schedule the talk webinar into 3 sections. So the first one is like getting the first meeting. Like we all know there's a lot of people raising, we know there's lots of funds out there, but how do you get that first meeting? That's kind of the first topic 1, which will split into a few questions. The second topic is like, great, got a first meeting, super pumped to meet Chris and his team. But what does it take to go from that first meeting to that term sheet? Like the first meeting is just, and I used to be a VC myself, you have a lot of first meetings, so you have less second meetings, less third, and right down to IC. So like, what does it take to go from that first meeting to that IC? And then also, that's great, you've got the money, but that's literally the start of the journey. And I think that's what also people often forget, like fundraising is just the start of the journey. Chris hasn't invested in you just to let you retire, he's invested in you to build a big business. So the third part of the discussion today is how to succeed post-investment. From there, then we'll go into a quick live Q&A and go from there. The very first thing we'll do before we touch on those 3 things is just a quick view of the kind of state of the UK's pre-seed market from Chris's side and from Playfair's side. So for a couple of minutes, Chris, about what you're seeing, what's out there, and then we'll jump into kind of the rest of the flow.
Yeah, absolutely. So yeah, Mark and I were touching on this just before everyone joined. I mean, the market's fine, I think is the best way to describe it. We're not in 2021 boom times, at least not if you're building in AI, and we're not in sort of really difficult times either. I think there are funds writing checks. There are plenty of pre-seed funds in the market, plenty of seed and later stage funds coming down and writing earlier stage checks. So I'd actually say the market is pretty good. I don't think too impacted by the macro like chaos out there. So Trump and his tariffs, depressingly wars all around the world, they kind of have an impact on venture, but really at the later stages, where people are doing growth capital and thinking about sort of IPO exit windows and liquidity. At the pre-seed stage, we're like 10, 15 years away from even thinking about that. So I think it's generally a pretty good time and pretty good place in terms of the UK to be raising. The main thing we are seeing though is that VCs are annoyingly, they're sheep, and they really do get like massive doses of FOMO. So everyone's just investing in bloody AI. So like when I'm building an AI, like, you have my apologies, but like there are really good use cases for AI, and there are lots and lots of use cases that aren't very good. And we're just seeing the whole thing being chucked together, and lots of funds doing big checks at big valuations, and it's all going to end in tears, frankly. So there is a bit of a bubble there. What that means is if you're building a really good AI business, it's great because you can raise and you can get money. If you're not building an AI business, you're going to have to work extra hard to get the attention of investors. Thankfully, there are lots of funds like ours that like things that aren't AI as well, but it is a little bit more difficult. So, I think that's the context. Don't be sort of forced into just pushing AI into your deck for the sake of it. If you've got a really good business, there's a really big problem you're solving, the solution works, you will find the capital. It will just take a little bit of time. So overall, it's not a bad time.
My follow-up question to that is, I think, should people be thinking, like, even our business right now, like AI is not the core, but there's definitely some very, very interesting AI use cases that we are looking to do down the line as we build up the data set, as we build, for example, pricing data and review data and that stuff. Do you think people, even if they're not an AI now, say, look, we're not AI right now, but they should have something in their deck where they're saying, look, this is what we think we'll be getting there, we should be getting there in time? Or do you think that doesn't actually matter and that you can just completely ignore it?
Yeah, if it's real. So I'd slightly reframe it and say, I think what people are really looking for, investors are looking for, and I guess founders should be as well, is capital efficiency. Like, how can you build a really big company with as fewer people and as lower cost base as possible? And so that means in the old days, I'd be talking about automation, right? Process automation. And now I'd be talking about AI. It's kind of the same thing. What technology can you deploy in your business to make it capital efficient? So I definitely would be thinking about that. VCs hate businesses where your people and your people cost scales like linearly to revenue. They want to see that actually you don't need many people and you can blow revenues really, really high. So yeah, I'd be thinking about it. I'd be worried about being caught out if I just said, oh, we're thinking about using AI, because then you're going to get someone go, how? Give us examples. Yeah, well, we haven't really thought about it. So make them real, test them, and then include them, obviously. But I'd see in that wider context, how do we build a really capital efficient business? Fantastic.
Brilliant. So yeah, phase one of our topic discussion today is like getting the first meeting, which I think is really, really critical for a lot of people. So what do Playfair look for kind of in a deck? Like when you're getting a deck or the way that people are contacting you, what are you looking for to want to have that first meeting?
Yeah. So first of all, just how to get hold of us, I'll just quickly mention, we've got a pitch form. So pitch us, just submit your deck there. It takes, I think, 5 or 6 minutes and everyone gets reviewed by the team. I know it's harder for other firms. Some firms don't include any contact details. Then you're into the LinkedIn hustle and trying to get referrals and everything else, which maybe we'll talk about later. In terms of a deck, I think there are really simple rules. Short, because we don't have an awful lot of time to look at every opportunity. So keep it short, 12 slides, 14 slides maximum. Pay a designer, because ugly decks suggest that your product will be ugly. And so your execution is not top tier, however you want to describe it. So it needs to be super well designed, and it needs to tell a story that is both exciting and wants me to find out more. So don't tell me everything. Don't put like too much data in. Don't put, you're not throwing the kitchen sink at it. You're trying to get the first date, I guess, is what you're alluding to. So like, I want to know, this is a very interesting idea by a very interesting team building in a really big and exciting market. And then I go, I have to find out more about this. I need this half an hour call. Things I definitely will pass on, I'm going to call them like incremental businesses. So if it's something that you're kind of layering on top of something that already exists, we've seen maybe 20 or 30 companies trying to optimize sales calls and sitting on top of like a Salesforce or another CRM. It's nice, but you're not building a platform. You're building a feature essentially, rather than, you know, an entire business. So it needs to be something that's big and in a big market.
Fantastic. And with regards to team, that's always a really interesting one, right? And can be quite controversial as a whole as well. But what is impressive to you fundamentally? Like, what are you looking for in a characteristic and going, yeah, this person, this team, these people have really, really good insights or really good experience that I want to meet? Or like, what are you looking for? Is it that? And also, sorry, just for everyone else, if you've got questions, you just put them in the chat, and at the end I can then pull things through. So yeah, we'll just filter through the questions at the end.
Yeah, so I won't repeat it here, but I posted on LinkedIn not that long ago about the 9 traits we look for in founders, because every VC is going to tell you superstars, rock stars, sparkle, whatever, the X factor. None of that is very helpful for any founder trying to think about how their background and experiences maps onto what the investor's looking for. So we have these 9 traits. I'm not going to go through all of them now, but you know, one example would be like domain obsession. So is this person absolutely obsessed about the problem they're trying to solve? And, you know, you can demonstrate that either because maybe you've worked in that industry for years and you're like, it's broken, I'm going to do something about it. Or maybe you've come from outside the industry, but you spent like 2 years traveling around talking to everyone you possibly could about this problem, and you validated it from an external perspective. But really showing you're obsessed with the problem is one really key trait. And maybe the second one I pick up on is something outstanding. I mean, we've got in our portfolio, we've got like an ex-professional racing driver who like podiumed at Le Mans. Has nothing to do with building a company, but it just shows really, really high levels of performance and commitment and determination, like the things you need to build a company. And I was chatting to a founder recently who like he won the Oxford Cambridge heavyweight boxing match. I'm like, geez, like, well, first of all, I don't feel I can pass safely. But secondly, it's just a really amazing achievement, right? I think bring that out in the deck when you're talking about yourself. We focus a lot less actually on, I used to work at Google, I used to work at Palantir, whatever. It's nice, but there are a lot of people who've done that. So something that makes you unique, I think I really look for in a deck.
Fantastic. Which then brings us quite nicely on to kind of traction as well. I think someone else has messaged about product market fit, and a lot of funds say they're pre-seed. A lot of people say they're this. What does this even mean in this world, right? Some people say, oh, I'm pre-seed, but actually I want to have $1 million of ARR. So I'm not quite sure that fits. But how much does Playfair want to see? How much traction do you want to see? Do you guys actually go pre-revenue? Tell us about that kind of journey.
Yeah. So the answer is I don't want any traction. I don't need any traction, because the whole point of venture is to be funding people who want to build a business. It's going to cost a bunch of money because it's complicated to do it. How could you already have sold stuff? It just doesn't really make any sense. So we don't need any revenue. I would say of the 60, 70 more companies we've invested in the last 5-6 years, a bit longer than that, 10 years, 3 or 4 probably had some revenue, just because that's how they've grown up. But in general, we don't look for it. What we do look for, though, and I actually posted this on TikTok a few hours ago, we look for validation. So we look for founders who have gone out and figured out, okay, I've got this idea. I am as confident as I can be before I build it and try and sell it that people want it. And that could look like speaking to like several hundred or several thousand potential customers if it's a consumer business, or it could look like speaking to 2 people who could be like your co-design partners or co-development partners. But going out there and actually doing stuff to validate that this is a good idea from the people who might buy it is really, really powerful. I think actually a lot of pitches fall apart when everything looks brilliant, looks really slick. Well, what have you done so far? Well, nothing. We're waiting to get funded. That's not great. Even if you don't have any money, there's lots of stuff that you can do to go on this kind of this validation journey.
Fantastic. And what's some of the kind of within doing that? What's some of the kind of more unique things that you've seen, or something that stands out and go, okay, they haven't got revenue, but they have really gone above and beyond to prove this is something that we should be getting involved in? And then I guess my follow-up question is, if they've done all that work, why can't they get an LOI? Why can't they get some basic revenue, even at £10 a month? Like, why is there not a disconnect between the two?
Yeah, so I can think of 2 examples actually. So one is so AeroCloud, one of our companies, they supply software to airports to help them manage their operations. So George, the founder, he spent 2.5-3 years traveling to airport airline conferences, speaking to all the owners and operators at airports to find out principally the shortcomings of their current solution. So why do they actually hate their current providers? And it became abundantly clear that there's basically two providers. They're all very old school, 30-year-old software, on-prem technology. This market is ripe for innovation to build something cloud native. So he validated it like that. Why didn't he get any revenue? Well, he needed to build the thing, which cost money. But it didn't cost him that much to like tack onto his holidays, you know, alongside his job to go and see all these people. The other example I like, we didn't also invest in this company, but they were basically building an alternative to Excel, particularly for like the asset management, financial services industry. And we saw that and we're like, Microsoft's quite a big company. It's going to be quite tough to displace them. They came at us with like, it was 200 or 250 interviews they'd done with their users within banks, like private equity funds, hedge funds, saying, yes, we would use this. And this is why. These are the features we want. These are the shortcomings of Excel. And we were like, wow, it's really compelling. What it proved to us is that there is extreme dissatisfaction with Excel within these industries. Unfortunately, we couldn't quite get there on the belief that they would be able to replace it nevertheless, but really impressive in terms of validation.
Fantastic. And I think we sort of touched on this, but I think it's kind of a different angle, but and it almost goes back to how best way to contact, but how do founders stand out in a very crowded market? So there's a lot of founders trying to raise, and obviously warm intros are very important, but that's also not very accessible, which is why you guys do such an amazing job of being able to anyone to be able to submit something. And I guess it's like other things that you've seen on your journey, other things you've seen where people kind of stand out in different ways, and any unique insights you've got into how founders can actually stand out more than just using it instantly and cold calling you 100 times a day.
Yeah, you know, I think the product, so cold calling or cold emailing is incredibly powerful, and it's just done so badly. So I don't know how many I receive every day, but like a lot. Most of them, well, let's not get my name wrong. Lots of them are very generic, or the ones that hit are like, I see that you've invested in this company, I don't know, some computer vision business, and I'm building in this space, which is adjacent to it. We're particularly excited about the market dynamics because of this. I'd love a conversation. You go, right, it comes down to research. You've done your research. You know who Playfair is. You know who I am or what I like investing in. It's hard, by the way, to know that because a lot of investors don't really publicize what they invest in. But if you go to the portfolio pages, you can kind of figure out often who the company lead is. And you make it personal. And I have responded, I think, to every single cold email that hits that level of quality of just like, it's researched, it's customized, and it kind of makes sense. And we actually invested into Continuum Industry as a company, again, in our portfolio. That was a cold LinkedIn message. It was brilliant. I think I wrote a blog post about it. It was like, you know, Chris, are you interested in like infrastructure technology? Yes, I am. Okay, great. Well, I'm going to be at Turing Fest next week. I understand you're there. I mean, a bit stalkery, but I was like, yes, I am. Okay, let's meet. You know, it was just beautifully well researched. So cold emails are really powerful. And just one word on referrals. I think people overemphasize the importance of referrals, because if you're getting a referral from a fund that is going to invest in you, super powerful. But if you're going to get a referral from someone that's passing on you, it's terrible, because basically so I'm going to pass it on to my friend at the fund and say, we looked at this, we're not going to do it. What do you think? They're going to go, well, why would I do it if you're not doing it? So just referrals are not the be all end all.
Yeah, it's interesting for my days as a VC as well. And I think people are really underestimated, especially our stage, where we're always looking for really high quality deal flow. And fundamentally, if you send me a deck with a good business in it, I'm still going to look at it. I'm not going to be like, oh, actually, it will take me 5 seconds, 10 seconds to flick it. At the end of the day, back to what you said, which is the deck compelling? Is it got a good team? Has it got traction? But ultimately, I will still look at that. And I think that's a really interesting thing you say there about warm referrals, which is actually quite a interesting take, unless you want to say, going to co-invest with me and say, well, I'm really convicted on this, or otherwise, no. I guess the only difference when a fund is later staging you and says it's too late or too early for us, and then passing it down that way. But there you go, folks. See, cold calling, but very, very targeted, very, very well researched, is still a very, very attractive way of doing it.
I'll add one thing. We call it the blurb. It's like a paragraph that describes your company, and it makes you go, wow. And we spend, as investors in our companies, we can spend probably days, maybe even weeks, refining that blurb. It's just so important, because that gets sent out with the deck to all the investors that we want to fund our companies at Series A or Series B and beyond. It's just so important. You get it right and you go, I've got to speak to this company. So really refine that as well. Your cover email is probably more important than the deck to get that initial excitement.
Fantastic. Love it. So we've done that bit. So I think we're on to section 2, which is you sent the deck to Chris. He is buzzing to meet you. He's absolutely, and I do think actually as investors, you do get be genuinely really excited to meet companies. I think sometimes founders of VCs just sit with the money and the ivory tower, but actually as a former investor myself, I know Chris, like you're genuinely very excited to meet the people who are building the technology to change tomorrow. And I think that's a really important part of it as well. So meetings in the diary, fantastic. What does the first meeting look like with you? Like time, what are you going to be asking? Do I go through my deck with you? Do I not? And also, I guess, folks, with all of this, like every investor is going to be different. There's not one size fits all, which is important to note. But obviously, Chris is our lead today. So what's your views on this, Chris? What does the first meeting look like with Playfair?
Yeah, well, first of all, it's a great point. Every meeting is different with every fund, but also every individual investor. So I was talking about this one on my team the other day. My style is I'm going to ask you, well, first of all, I'll tell you about myself, obviously, and then I'll say, look, tell me about yourself, and tell me your story. I will give you, say whatever you want. So that's the opportunity. You've got a really good elevator pitch. You can do it, and then we'll probably jump into a back and forth kind of Q&A. Whether you want to use the deck, I always leave to the founder. So often the founder says, do you want me to use the deck? My general sense is it's a good idea to do it, because you have spent a lot of time on it and it helps frame and structure your thoughts, but limit it to 10 minutes. And by the way, these calls are normally about half an hour. So try and get through the deck instead of 8 to 10 minutes and leave plenty of time. Other members of my team will pepper you with questions, particularly Simon, who's the chair of our IC. I mean, damn, like he'll just go with questions. Actually, the easier pitch is when you're being peppered with questions, because you know the answers. The harder one is when you're given more space to talk. So be really conscious of the amount of time you're speaking, and stop and pause and check the investors paying attention. It's really bad, but a lot of investors will drift off. So stop, get them to ask you another question. You have to make it a dialogue. It has to be a back and forth for it to be interesting. The worst founders that I've had pitches with, I have said, tell us your story. They go for the whole half an hour. And it's understandable, because it's like you're so passionate about what you're building, but I'm not going to stop you, because if you can't stop yourself and you don't have that awareness, it's going to be really hard for you to raise money in the future and convince other people to come join you and everything else. So so I would say ultimately, yes, half an hour. Use your deck, I definitely would, but keep it really short, and make sure you get into like a Q&A. Make sure there is a dialogue going on, and make sure your investors paying attention.
Fantastic. And it's almost like the job interview thing at the end, right? It's like, should they ask questions about Playfair, what you look for, what you're interested in? Is it more important to use that time to sell yourself? Like, do you like to see that kind of reciprocal, I do care about you too?
Yeah, I love founders asking questions. I mean, I think in the first call, I probably would ask less about, what are Playfair going to do for me? I could talk about that all day, but I don't think it's that helpful for you. I would ask more, how does this fit in your investment thesis? What were you most excited about, in the discussion we've had today? Any sort of glaring concerns, from this conversation? A lot of investors won't want to give you feedback on the fly, so it's actually quite nice to put them under a bit of pressure, because then you'll get what they're really thinking. And they might just blurt out, I just am a bit concerned about the market. Well, then that's really valuable information to take into the follow-up email or the follow-up call or whatever it be. So I would definitely do that. And the other thing is, the worst thing that happens is investors will generally be really lovely to you, because they want to preserve optionality. They want to make sure if your company gets hot and suddenly, I don't know, Sequoia or A16Z or Axel are talking to you, they're still talking to you. So they're going to say, this is great, thanks very much, speak soon. Hopeless. What it means is that your pipeline of all the investors, it all says no one's passed, it all looks great, but it's not real interest. It's just like a sales pipeline. So try and qualify it with those questions at the end.
Fantastic. Yeah, I think that's that was one of my favorite questions that I used to get asked, was what are your biggest concerns about this deal, this investment right now? Because actually, when you go through a call, when you go through, from my experience, you talking to the founder on that side, there's always one or two things that go, that's concerning, which is niggling at me. And very often you'll voice it. And actually, when they ask you that, to be able to follow up and go, and I think TAM's a really interesting one. We got that a lot. I'm actually really worried about the TAM on this. And so I was like, well, actually, here's a spreadsheet I've built with all of the reasons why, and here's a bottom-up analysis, a top-down analysis, and everything else. You can almost go, oh, okay, you do know far more about this market than I do. That's one from being a red flag to maybe an amber. And obviously, too many red flags, I would kill the deal. Amber's is something I need to sort out in my own DD, but that probably means I'm going to consider thinking about it from there. And then I guess we've done the first meeting.
Yep.
Went well. Do you guys typically, and I can probably get the secret sauce out, Chris, here for all you guys here, do you guys, the ones you're like following up within an hour, 2 hours a day, is there a certain amount of time when you're like, this is a good sign, this is a bad sign, take nothing from it because you meet once a week? Is there a certain like indications?
Yeah, I think the process, we'll take that first call, we'll discuss as a team, and then we'll go to a second call, which will usually be longer. It'll be 45 minutes to an hour, usually with 2 members of the team, and usually picking up on areas of concern we have from before. So one company I'm thinking about, they're going to really dive into how unique the tech is, and they're going to dive into the sales pipeline because we think it looks a bit light, for example. After that second call, we then make a decision whether we're going to write the investment memo, and maybe we talk about that from there later on. But yeah, I don't think there's any massive sign other than an increasing level of communication over time. So you'll generally see, I might send you an email. There was one founder I was sent like 14 questions on Good Friday because I couldn't get this company out of my head. That's a good sign. As Mark's saying, this is actually a pre-seed. It's quite an emotional business. Like you just can't stop thinking about companies over the weekend. That's just really, really cool. I need to find out more. So if you get those emails, those questions, that increasing level of interaction, that is generally a fairly good sign. And
then I guess on the counter to that, as you said earlier, like when everyone's on the pending and you've not heard back from a week, do you have any advice on someone to be? Obviously, you don't want to be like, please just give me a decision, but you also kind of know you're seeing hundreds of decks a week, and at the end of the day, if you're not in that 6 you're going to invest in a year, you're probably not going to get the investment. So do you have any advice for founders where it's like, okay, kind of, if they're not hungrily coming back, don't waste time and worry about that, almost put them to very unlikely on the thing, or keep chasing and chasing? And I guess it's almost like that dating thing again, right? It's like you both had a great first date, you're like, wow, I want to see you tomorrow. You've had a met first date and everyone's ghosting each other, and it kind of goes into that. Do you have any advice on whether you should follow up and stuff, or whether you should like focus your output elsewhere?
I was just thinking about, I generally don't think chasing investors is a particularly good idea, because I think as you said earlier, every investor wants to find great companies and every investor wants to do great investments. So they're aligned ultimately with what you're trying to do as well. But if they're not coming back, it's because they're working on something else and another company is taking their focus and their priority. Only time I would chase is if you've got a round crystallizing around the term sheet that you've either got in hand or you're expecting very soon. That is a great time to go back through the long list and just say, look, the process is going really well. We're starting to wind up, we're expecting a term sheet, or we've got a term sheet now, would love to just know where you are. That can crystallize some interest on people who are maybe just prioritizing something else. But like routinely, I would just move them, as you say, into unlikely if they're not getting back to you.
Fantastic. Some really great gems here. So next question is, what data and material should the founders have ready to go? And I think from my context and my background experiences, so you might have a great first meeting and you're like, great, really pumped. I want I was Series A, B guys, so it's slightly different, but so I wanted my fundraising model, I wanted the historics, the forecasts, I wanted some of the data, and they're like, oh, actually, I've got to go and build that now, sort of thing. And that was never great, because almost you got that excited momentum, you want more. But at the pre-seed stage, I guess, what materials and data should they have ready to go before they're approaching you to keep the momentum going, or does it not matter?
Yeah, so I think, first of all, there's a really good expression, it's not mine, but deals go to data rooms to die, which I think is a really great expression, because what it essentially means is if you give someone access to a data room with loads of like unstructured documents, there's no commentary around it, there's no storytelling, people just get bored and they stop looking. So I would really tightly control the release of information to investors. So start with your deck. Obviously, you need that to go out in the first place. The next thing people are going to want to see, even at pre-seed, is a financial model. It's not about, is this going to be entirely accurate? It's about your assumptions and the way you think about things. So how does the business scale? Are you reliant on ramping up your number of SDRs, for example, to bring in sales? And what does that look like? And what's the efficiency? Want to know about burn rate. We want to know about salary costs across the business. We just want to get a real sense for like, where's the money going to be used and how efficiently is it going to be used? And then the data room, to be honest, I don't really care that much. I'd use it for two things though. So I would use it for like hygiene stuff. So show me the company is really well organized. Like you've got your incorporation documents, you've got your founder service or employment agreements, and they're all sort of, they're properly done. Make it look like a really properly put together company. And then the other thing is it's just a bit of showing off. So include really cool videos, include a few press articles and things like this. I think most people are now building in Notion, which just makes data rooms a lot more attractive and actually does allow you to put a commentary around it, which is much better than just a Google Drive with just documents in there. But I control that information, deck, then module, and then only really serious investors should get access to the data room. I think once you've had 2 or 3 calls, or they tell you they're writing a memo, or they're going to IC.
Perfect. And that is a beautiful segue, if you couldn't have done it better, into that process from that first meeting to the term sheet. And then you mentioned something, an investment memo, like what is a memo? But yeah, I think so. We're just on the first meeting. I've given you the model you wanted. I've given you the deck. You booked in another call. What's that process from like there to term sheet?
Yeah. So you said you have the second call, a couple of members of the team. So at this point, you're probably met 3 of the team with 6 investment professionals. So you met kind of half the team. We'll say to you, look, we're going to write the memo now. What that means for you is we're going to go away and we're going to do a ton of references, market references. We're going to talk to experts, professors, whoever we can find to validate, what's being built and our excitement around it. That doesn't involve you as a founder too much, but we'd probably have maybe one more call, a few emails back and forth just to clarify a few questions. And then we'll get the memo kind of set. There's one more meeting before the IC, which is usually where you meet the whole of the Playfair team. We like to do it in our office. We can do it virtual. This is entirely a 2-way thing. So we want the whole team to meet the founders before we go to IC, but we want you to meet us, because if we invest in you, get all of us. You don't just get one person. And that's usually a 2-hour session. The whole team sessions is the first hour, and then the people who are leading the deal will do the second hour to focus on the last questions. And then we go to IC. And IC is internal for us. So we do not expect you to come to our office, sort of parade you in front of partners you've never met before, in front of long tables and all these kind of power plays is bullshit. So we do our IC internally. We know everything we need to know about the company. We've got the memo, and we go to IC. Usually it's a 2-hour conversation. Actually, I'll tell you, we vote. So basically everyone votes, number between 1 and 10. You can't vote 5. 6 and up means we want to do it. And then conviction between 6 and 10, obviously 6 the lowest, 10 the highest. And then 4 and less is we don't want to do it. And again, conviction, anti-conviction. 1 would be the worst. 1 is I'm going to resign if you do this deal. We then have a 2-hour conversation led by the chair of our IC. We go through the investment memo, and then we vote again at the end to see if anyone has moved position, and then we agree what we're going to do. I should say the final thing, throughout the process, we try and give you as much visibility as possible. So we'll tell you what we're concerned about. We'll tell you what we're deep diving in. So we looked at a company recently, we got to memo stage, and we said, we are just concerned about the market. We think what you're building is really interesting, but we just don't think there are enough customers out there. So we did a very specific piece of work on that over 3 or 4 days, had a call with the founder to talk them through it, and then ultimately passed, and then sort of handed that work over to them and just said, this is what we're concerned about.
Fantastic. And that third meeting where you've had the 2-hour session, first hour with the whole team, first hour after that, you'll get a bunch of questions out of the back of that, or things that you're then, and then you're going to do some more basically desk work to then make a final IC memo, which you then take. Is that right?
Exactly. That's right. But I think by the time that we're meeting, it's all of our team and then the 2, 3, 4, whatever founders, we're pretty much there. I think we kind of think we want to take this to IC. We don't take things to IC unless we hope they're going to actually happen. By the way, we're about 50% of companies that go to IC is a yes. So this is actually pretty high given the other stats in venture. So at that point, we're pretty set, and we've done most of the work.
Fantastic. Great. So done that, the IC meeting you've explained. So that is absolutely fantastic, and we're good for time. So congratulations. We've now got a term sheet from Playfair, and possibly a few others. And this is where it becomes really interesting, right, Chris? Because this is almost where the tables start turning, and it goes from being like, I want investment to, I might have 3 or 4 or 5 term sheets here. And I guess my thing is, why should I pick Playfair? How do I, at that point, if I'm the founder and I'm in the situation, why should I pick you? And also, more generally, what as I founder, and I guess ignoring Playfair from this to make it a bit more generic advice, is what things should I be considering as a founder that means that this is the right investor for me? So let's do that one first, take Playfair out, and then we can explain why Playfair would also be a great fit.
I don't know Playfair because I could sell Playfair all day long. Maybe we'll come back to it, but I would think about kind of three things. I think about terms. So you should check. We've got on our website, our term sheet is there available to download, so you can have a look. And I wrote a blog post about key things to look out for when you're doing a term sheet negotiation. So terms, make sure you're not getting screwed. Make sure there's no crazy preferences in there. Make sure there's no crazy board setup, whatever it is. Just make sure you're comparing like with like. So let's assume all the terms are the same. You've knocked out the crazy ones. You've got a couple. I then look at relationship with the people, not the firm. I mean, the firm is important. Brand is important because it helps you raise the next round of funding. But do you like the people? Do you want to work with them? Do you trust them? Do you think they're going to have your back, particularly when things get difficult, which they always will, even in the most successful companies? And I'd validate that as well. Go with your gut is fine, but I would validate that by speaking to as many founders as possible that they've worked with. Again, good companies, bad companies. And normally what I do is they will recommend probably, we always say, speak to these three people, these three founders, because we think they're the most relevant for you. And normally they are. We're not gaming. We're not just going to give you three good ones, but they're good because you're in pharma or health and they're in pharma and health. But speak to others as well. So do that to validate the relationship. And then the other thing is I talk about value add, but it's more like value add fit. Like, what do you need? Because if you want, let's use the health and pharma example, if you want specific pharma knowledge and access to big pharma companies, you should go raise from someone else, or you should have us on the cap table with a specialist. So I think about what value you actually need. If you need someone who can help build your sales team, or go to market motion, or is good on finance or fundraising, then great, you should chat to us. And what I would normally think about is how can you optimize your overall cap table? So it's not really about which term sheet you take. It's about how do you get the right mix of people on the cap table. Best cap tables, normally in my head, one or two institutions, sort of VC firms with complementary skills, and then angels who know the space, can get you access, can kind of share their experiences, and you bring all those people together, and that is usually the best mix.
Fantastic. How often are you co-investing versus just sole investing?
Almost all the time. I think we must be like 70-80% will be co-lead. It just makes sense. I mean, we invest across Europe, so a lot of the time, if we're doing investments in Switzerland, there'll be a local Swiss fund and there'll be us, and then that's beautifully complementary because you have the local knowledge and then you have the sort of international perspective as well. But yeah, most of the time. Also because most rounds are bigger now, so most rounds are like 2 to 3 million pre-seed if it's if you've got something that people are interested in. And then, our checks up to 1 million. It just kind of makes sense to co-lead. And as a founder, one other thing about that is if things aren't going very well and you need to do a bridge, it is much, much better to have two funds to go after for a couple $100,000 each than it is to have one fund that goes, oh God, we're just not sure about it. So just think about, the upside, but think about the downside scenario and how much cash is sitting around the table.
I think you can probably give some views on this as well, but no journey is ever up and to the right. Like, no matter how much you raise, no matter what you're doing, there will be times where things are going wrong, you need a bridge, whatever. That's actually very, very normal. It can end up being usually successful at the end of it, but having that support around the table.
We had a company that's now the last funding round was worth 2 billion, and they had a cash crunch that meant they had to do a convertible. They had days left, and we participated, as did a couple of others, and without it the company wouldn't be here. So it's nuts, like how close you can get to complete wipeout when ultimately you build something massively valuable. It generates a bit of gray hair.
Yeah, absolutely. Which brings me on very nicely to the next bit for the last few minutes is we've got the investment. We're super happy. Chris is working alongside me, absolutely buzzing. But this is where the journey starts. I'm trying to get to my seed round. What do you see? What are the biggest tips you see for founders trying to get from pre-seed to seed? What is the difference between seed and pre-seed? And then what's the biggest thing about getting from that journey, both, I guess, pre-revenue, pre-traction to then revenue and traction? And what are the biggest advice for people to get from pre-seed to seed?
Yeah, it's a really nice way of framing it. So I'll just a general point to start with, which is that when you have your first board meeting, it feels quite intimidating. I mean, but it's not. It's actually just a meeting, and it's a meeting to discuss what's going on in the company, the challenges and issues that you have, and to try and get some input and some advice on it. But you have to take a really big mindset shift, because you've been selling your company for the past probably 3 to 6 months. Like, fundraising takes ages, including to the person who is now your board member or your board observer. Switch the mindset. You now need to tell them everything that's going wrong, everything you're worried about, everything that's keeping you awake at night, so they can help you. And companies that often fail or do badly don't make that switch. They just sell to their investor for the 18 months, and then they run out of money, and the investor really never knew about it. So let your investor in. And also remember that the investor's just giving you money. There's no way out. The money's in your account. So you can tell them everything you need to tell them. The slight nuance is, as you get close to the next fundraising window, you have to slightly tweak that. You can't start just telling them everything's going wrong. You have to start telling them some good stuff as well. So remember that it's really key, that kind of management of your board. And then I think the companies that do well don't spend the money too quickly and don't rush, which sounds really counterintuitive, because obviously venture is about building big companies, and it's about doing it in a kind of crazy to build £1 billion company in sort of 5 to 10 years. But if you go out and start hiring, if you start bringing people in too quickly, you change your culture, you haven't had time to solidify your playbooks, to solidify to the point of product market fit earlier, what actually works. So take it relatively steadily, right? You're gonna figure out, okay, this works as a sales tactic. I'm gonna do it. I'm gonna do founder-led sales all the way through seed. Only once I get to Series A plus am I gonna hire a salesperson, would be one example. So keep it lean, because it helps communication and it gives you room to maneuver if things start to go wrong. And then the final thing is, I would start to, hopefully already really understand what the seed milestones are, because there's no good building not knowing what you're actually heading for. And I think seed milestones are really hard to kind of discern. I mean, A milestones are quite tricky to figure out as well, because it's moved so much. It used to be $1 million ARR. Now there's a guy posting today saying it's 2 to 3, which I think is BS. Like, it could be 1.5. But the point is, it's not totally clear. I think sit down with your investor and say, right, what do we need to do to get to seed? Because that's what they're there for. They should know, okay, I think this company needs, and it's going to be very different. It's going to be a revenue number. It's going to be a certain number of POCs, a certain number of co-design partners, a certain technical milestone. It's quite bespoke. So make sure you know exactly what you're building to.
Fantastic. 2 follow-up questions. One is, keep it lean. How lean is lean? Like, what are you generally seeing from that? I know every business will be slightly different, but what does lean look like?
So we think about it as, what in the company, what's the bottleneck? What is holding you back from moving faster and achieving more? And then how do you put that into a specification or a role? So you might find, maybe give one example. You might find like the CEO is doing tons and tons of admin, or loads of presentations, just lots of fairly more process orientated tasks rather than spending time in front of customers. Okay, that sounds like a founder's associate, or it sounds like some sort of administrative support, or it sounds like a bookkeeper to do your payroll and your administrative stuff. Your job, I think, as a founder in these early years, we were talking about earlier, you're kind of staying at 120%, being realistic. You're going to work bloody hard, maybe even 150%, but you can't go above that, because then you'll start to not be able to generate what you want to do. You'll start just not being efficient. So I would think of it like that. When everyone is full to bursting, what can you spin off into a new role? What does that look like?
Fantastic. And then seed and product market fit. So do you need product market fit before you hit seed? Is product market fit more of a Series A thing? What's the kind of latest narrative in the industry right now?
I mean, I see seed as early product market fit. I mean, you can't have product market fit almost by definition, because you haven't sold to enough of the market. But if you've tightly identified your ICP, you know you're selling to this particular customer, and you've got 4 or 5 or 6, who are all paying for it. What I love to see, and it's not necessarily realistic, but as a renewal cycle, that's lovely, because then you can go, well, we managed to renew this customer. They still want to pay for it. And they're also prepared to pay a sensible amount of money for it. One thing that hurts companies is they underprice. And so what happens is the investor looks at it and goes, well, this is great, but if you actually sell to the whole market and you're only charging 200 quid a year, it's just not a big enough market. So be really careful about underpricing. my suggestion is always start from a rate card and then discount to the rate card, so you can then pull it back when you go to renewal. Don't do bespoke pricing because you get really stuck there. But yeah, I think you want partial product market fit, and then to me, Series A is product market fit to the point you have enough confidence that what you're doing is just putting fuel on the fire for sales and marketing to just sell more of it.
Perfect. I think we touched base just before everyone joined, so I think you had some really good insights there into people on that journey to find product market fit. What are like the 2 or 3 key insights that you give all the founders here on their journey to get to there?
Yeah, so I think it's really difficult actually to figure out when you're talking to a customer whether you've got a sales problem or you've got a product market fit problem. So you may just think, damn, I can't get any traction here. It's just because my sales tactics, my sales strategy is not working. It may just be actually they just don't like the product. How do you figure that out? Well, the first thing is, I was saying to Mark, founder-led sales. This is the only way. Like, you have to be listening and in front of the customers and hearing their feedback. You have to be absolutely scrupulous at keeping a list of all the rejection reasons and all the things you're hearing from the customer, because they are telling you things. Some of them are telling you things to get you to go away. Some of them are telling you things because they just don't want to talk. But some of them are actually giving you hints and tips about the product. And I think if you'll probably feel the journey to product market fit starting to happen when you can actually get customers to talk to you sensibly about the product. If you're not even getting in the door, then they probably just aren't interested, and you're not solving like a hair on fire, like, top 2 problem for them. So just keep going, keep that feedback loop, keep it tight, keep it really quick.
And how long does it typically take, have you seen in your journey, or if your founders?
I mean, sometimes never. That's the reality. Look, it depends what you're building. I think there are some companies where product market fit is a significantly higher risk because, I don't know, let's say you're building a very deep technology, right? You have to make a decision about your architecture and what you're building. Unless you're building in quantum. You've got to build something, and 3 years later you've got something and it works, but no one wants it because technology has changed or whatever.
So like B2B SaaS or something more like generic, I guess, B2B software?
Yeah, I think if it's SaaS and you build, if you build in a modular way and you build the thing you think the customer wants most first, and you can create software a little bit quicker nowadays, then I think you can get there in months, not years. So I think you should have a very compelling story by seed. That, look, we went out to the market. This was our thesis. We thought that, I don't know, the aviation industry needed this. We've got 5 people paying for it. We think we need to build these additional modules, but in general, we think we're kind of headed in the right direction.
Fantastic. Yeah, I think it's interesting what you said there, because I think the pre-seed is not to get to product market fit. Really, it's that journey of, we have some people using our product and are willing to pay for it and have got value from it. If we've got 5 or 10 people doing that, we can now find 500, 5,000, 5 million. But if we've got no one on that, we still haven't got anywhere on that journey. And I think that's the interesting bit, right?
And this is why, actually, I think we talked when we were on our offsite in January about, will we ever back teams who are just teams and a deck and no, like we talked about earlier, like no validation? And the answer is no, because it doesn't matter how good you are in terms of your background. You've got a time disadvantage because the money hits the bank. You haven't even started thinking, really. You haven't started building. So I think starting to build, whether you're using no-code, low-code tools, whether you're distributing your product via WhatsApp, whatever it is, whatever hacky thing you're doing to start to get that journey to product market fit, the earlier you start, the better. I just think, for me, if I was building, I'd be like, the money hits my account. I know I've got 18 months runway. Realistically, I've got to be raising after 12 because it takes 6 months. I don't want to run out of cash. I've got a year to build an entire product, sell it to people, get people to love it. That's hard. So start early.
Love it. Fantastic. Cool. To Q&A. So anyone who wants to do Q&A, there's 9 dots on the bottom right-hand side. Drop in a note in there, and then I will pull out the ones that make most sense for the conversation from here. So the first one was from Felix Robinson. Thanks, Felix. And it says, at the pre-seed stage, where product market fit is still evolving, very relevant, what signals or behaviors do you look for in founders that can give you confidence that they can iterate fast and build something truly fundable? So very interesting parallel, kind of where we are at and a bit evolving.
I mean, I like founders that explain the journey, actually. So, this is our product, this is what we're building, doesn't really tell me much. I think if you tell me the story from, we identified this problem, this was the first version of our product, it didn't quite work because of this, The key thing we found in this industry is they want that. So we tweaked it and did this, and now we're seeing whatever it is, more users, more engagement, higher sales conversions, whatever it is, we want to see that journey. So I think don't be afraid to like open the book a little bit and tell the story, because at pre-seed, we're not looking for the perfectly polished, finished item. We are years away from it. We want to see the thought process you're going through, and to your point in the question, how quickly you're iterating. So again, I'm going to use Georgia Aerocloud because I've been talking to him today, but like their first business was actually a bidding site for last minute business class seats. I mean, sounds
it?
Yeah.
Wow.
Yeah. Sounds quite interesting. But they were like, this is not going to work for various reasons. So then, you know, it's a pretty massive, actually quite a big pivot, but it's within the same industry to do airport operations management. But when he told me that, I was like, okay, so the fact that you've gone through quite quickly, talked to enough people to know that doesn't work, gives me actually a bit more confidence that what you've come up with will work. So kind of show your workings, I think, is what I'd say.
It's just like a good math problem.
Yeah.
Interesting question here from Emma. There are a lot of people doing kind of fundraising advisory out there, and we'll help you fundraise your pre-seed, and we'll take 5% of your round. I am paraphrasing this slightly, but do you happily engage with advisors who can send you decks, or do you actually think, you know what, I need the hunger, I need the founders to be doing this, instead of outsourcing what is arguably critical? I know I probably biased that slightly, but would you look at the founder in the same way if they're using an advisor to help you raise their pre-seed?
I generally don't care where a company comes from, because I think I'm looking for stuff that is not in the mainstream. So I don't really mind if it comes from a broker or an advisor in another country and it's super interesting. What I generally find though is the best companies don't. And I think that's because, it's a bit like the product market fit thing, actually. It's like founder-led sales. It's probably like founder-led fundraising, that you need to be close to the fundraising process to know what VCs think about your company. And it's really important that you do it at pre-seed, because you're going to do it again at seed and again at A and again at B. And the more you practice, the better you'll be. So I personally wouldn't use them, but we will still entertain them. And the one thing I will say is never, ever, ever have one of these advisors on a pitch call, because that usually it's a bloke. That bloke sitting there staring at the screen, saying nothing, doing their emails is the most off-putting thing in the whole world. So if you're going to do it, have them in the background doing the heavy lifting for you. Just don't expose them to the investors.
Really great advice. Another question here from Karthik. I presume if I got pronouncing that correctly. Apologies if not. Really interesting. We've got customers right now. Congrats, well done. But the investors keep asking for more. It feels like the goalposts are constantly shifting. And I'm going to paraphrase this slightly as well, just add a bit of my own flavor onto this. It's like, what does this mean when it's just like, I want to see more, I want to see more? And then how do you avoid this like constantly coming back? I've got the 5 more now. What does that do? And they're still like, well, they want to see more. Is there something more underlying there?
Yeah. God, it's annoying. It's really hard to know what's going on. So either they don't actually like you that much. They just think you're not the founder we want to back, and they don't want to tell you. Impossible to ever figure that out. I remember being at a conference once where one VC, he moved, I think, from the US to London. He's like, I'm going to change the game. I'm going to tell founders exactly what I think. He did it for a week. Because you can't just say, I don't think you're good enough. It doesn't work. That may be happening. The other thing that might be happening is you haven't managed to create any competitive tension in the round, and so everyone is just sitting on the sidelines. How do you do that? It's hard, but what you want to try and do is get the ecosystem buzzing a little bit. And I hope it's not, maybe it's not too late, but you basically want to go out with your deck to a huge list of investors, like 100, 200 investors at the same time. Have first calls in the first couple of weeks, second calls in the next couple of weeks. Keep everyone in parallel, because everyone will talk. So when we launch Series A rounds for our companies and help them with that, we're like, we want the whole market to be talking about it. That way people feel the FOMO to actually write a check. Otherwise, it's just going to drag on and on and on.
At 99%, it's pretty unfair. But, a good chunk of VC is still FOMO, and it's still amazing, where things will close quicker, valuations will be much higher when everyone's kind of either getting confidence that their mates are doing it, or like co-investors, or actually just fear of missing out on that big thing. It's why didn't you do that? And actually, there is that. Really, is the FOMO world in the VC, because ultimately, only 1 in 10, 1 in 100 of these are going to be hugely successful, and so you kind of don't want to miss that punt. You don't want to miss the Figmas or the deliveries of this world.
Just to add one more point on that customer question, actually, I think it'd be interesting to look at, repeatability, maybe the thing they're concerned about. So they may be concerned about those initial customers you've got through personal network or some other scrappy hacky method, which is great, but it's not repeatable. So they're worried that you're not going to find the next 5 or the next 10 or the next 15. So really exposing to the investor like how you're doing customer acquisition, what your CAC is, whether the CAC is sustainable, and then showing your sales cycle hopefully reducing in time may help. Because I don't think they're necessarily looking for like we have to have 10, we have to have 15, we have to have 20. I think they're looking for repeatability and the sales cycle reducing.
And I would also probably add to that as well, if you haven't already, just really ask them and just be like, look, is there something specific you're actually, and also VCs are just humans. And actually, if you go up and dig in with the right question, they'll actually give you the answer. Like the question of asking them, what are you most concerned about in our fundraise? Just actually ask them, like, what is it about this? Is it this? And just ask the question. Cool, we've got 2 minutes left. So interesting question here from Lewis. Repeat founders, the wonderful, magical repeat founders. In fact, there's 2 questions I'm going to merge again, so sorry for butchering them. But does it matter if a founder failed the first time but wants to have another go at a different business?
No, but it depends. So I think it depends on why the company failed and the lessons you've learned from it. This is all about storytelling. So I met a really great founder the other day. I'll try not to give away who it is, but they built in robotics before. They couldn't quite get the Series A away. And they learned so much about robotics, about what investors are looking for, about tricky markets. They emphasized, brand over really focusing on sales, etc. And they're building a new business in robotics. And you're like, okay, this actually strengthens the argument of this is a person who's investable, because I'm going to take everything I've learned from the previous company and put it into this one. So I think if you can use the story that you have learned things that are relevant to the new company, you've learned things as an entrepreneur, as a founder, I actually think it can be strong.
Amazing. We're there for time. So Chris, any final nuggets of wisdom you want to release to the world? Any other anything else? Any fun facts you want to release to the world? Just wrapping up this whole hour, I guess, of anything you want to say, just to wrap it up.
Yeah, look, nothing huge, but I think first of all, you can pitch us. I'd love to hear from you. So go to our website. There's a pitch form. Submit your deck. It would be great to have conversations with many of you. I think the other thing is it's really bloody hard. So I think I always say to people, just don't give up. It's really, really hard to fundraise. And then they say, yeah, but like, what if I waste my life doing this? And then I say, okay, fine. If you've been going for 6 months fundraising and it's not happening, then you reevaluate. But you need to give yourself a really, really good amount of time to actually get the fundraising across the line. So yeah, good luck to everyone on the call.
Fantastic, brilliant. Well, thank you. A huge thanks to Chris. It's been absolutely fantastic chat. Our plan for everybody else is to keep doing these every few weeks, maybe months, we're not quite sure yet, and do a whole series just exploring the whole world of venture and really letting you kind of get into the insights from there. And we'll send a link through, but you can go to joingathr.com, sign up for all our events from there going forward. And if you need any providers to help you on your journey, you can also find them all there. So huge thank you, Chris. Really appreciate it. And thank you to everyone for joining.
Thanks, Mark. Thanks, everyone.
Thanks. Bye.